Hi traders, welcome to a new video. Today I'm going to be talking about Forex and CFDs versus futures and why I think I see so many traders when they're starting out. They usually start out in markets like crypto, Forex, CFDs, and then eventually as they get more serious and better with trading and more experience, a lot of them tend to gravitate into the futures market. And I'm going to go over qualities of each one and what are the advantages with futures and why I think that is such a good market for traders to move into. So let's start off with just a few definitions first, and then we'll go into more details. And then in the end, we're going to go through a whole list going over the best aspects when it comes to futures and why are the advantages of you thinking of making the switch. So first, what is Forex? Forex trading is buying and selling of global currencies. It is the world's most traded market. It's how individuals, businesses, central banks, and governments pays for goods and services in other economies. Whenever you buy a product in another currency or exchange cash to go on holiday, you're trading Forex. However, a significant portion of Forex trades aren't for practical purposes. Speculative FX traders seek to profit from fluctuations in the exchange rates between currencies, speculating on whether one will go up or down in value compared to the other. Okay, so when we talk about speculators, that basically means retail traders, just traders like you and me that are just trying to get in on trades and see if markets are going to go up or down, or currencies. Forex is traded in pairs, meaning that when you trade Forex, you're exchanging one currency for another. Forex markets are open 24 hours a day, 5 days a week, because basically at all hours of the day, there is some exchange in the world that's open doing Forex. And you've probably heard, the big three are Asian sessions where we got Tokyo, Hong Kong, etc. Then you got the European London session, and then London and other major markets. And then finally the US session with the New York main markets open. Okay, so it's open every week starting at 5 p.m. Eastern time on Sundays, closing the week at 5 p.m. Eastern on Fridays. It is considered a decentralized market, so you cannot get an accurate measure on volume activity. A lot of the transactions, as we said, are done what they call OTC, over the counter, between central banks, governments, etc. So when it comes to Forex, it's not a practical market to really use for order flow trading, because again, there's no real accurate measure of the traded volume on it. Forex is regulated in the USA by the CFTC and NFA and puts on more limitations than other countries. So if you're in the US and you're trying to trade Forex, you'll notice that there's a lot less brokers available for US customers, and also there's more limits on leverage, etc. Okay, now what are CFDs? CFD trading is the method of speculating on the underlying price of an asset like shares, indices, commodities, crypto, Forex, and more. And if you notice, CFDs always go hand in hand with Forex outside of the US. If you're in any other country outside of the US and you got an account with Pepperstone, FXCM, Oanda, etc., you're going to have access to CFDs where you're going to be able to trade other markets like the SP 500, NASDAQ, gold, Bitcoin, etc. in the CFD form. So what is a CFD? It is short for contracts for difference. It's a type of derivative that enables you to trade the price movements of financial markets. With this form of trading, you don't own the underlying asset. You're only getting exposure to its price movements. So basically, you're just trading a representation of the underlying asset and is just copying and following its price. Just like with Forex, they are highly leveraged and you can go long or short, and you only need a small amount of capital to trade them. They have the same trading hours as the underlying markets. CFDs are not permitted in the USA, okay? And the main reason they're not permitted is because the futures industry has a lot of weight in the US. They're very important, very big players, and very involved in the government and regulations, etc. And so they do not really want to have CFDs competing because they're very low costs and they would be taking market share away from futures, okay? And again, the main advantage and why a lot of traders start off in Forex and CFDs is because it's very low barrier of entry. You can open an account with as little as like $50 and just start trading Forex and CFDs right away. So it is very enticing because, again, you need very little capital, but you might get very wide spreads between the bid and the ask. So you're going to get very bad fills, especially on the more exotic pairs or when you're not at a very high liquidity period of the day. Like if you're not trading the London session or the New York session, and then you're going to get a lot of very wide spreads. There's also all these commissions, etc. Okay? Now let's go into futures. So futures contract is a legal agreement to buy or sell a particular commodity asset or security at a predetermined price at a specified time in the future. Future contracts are standardized for quality and quantity to facilitate trading on a futures exchange. The buyer of a futures contract is taking on the obligation to buy and receive the underlying asset when the contract expires. The seller of the futures contract takes on the obligation to provide and deliver the underlying asset at the expiration date. Now, most traders are not going to hold contracts open until expiration, but will just speculate on them at a current front month contract. So that's why you might hear every few months people saying that they're going to move into the next contract in NASDAQ or the S&P. That basically means the expiration on the current contract is coming up. And so they're just going to start trading the next contract in the future. CME futures trade 23 hours a day, 5 days a week. They open the week on Sundays, 6 p.m. Eastern, close the week on Fridays at 5 p.m. Eastern, and every day there is a close between 5 and 6 p.m. Eastern time, which is called if you hold the trade open from 5 to 6, it's called an overnight trade or holding overnight, because you're holding your trade open from into the close. And I'm going to talk later about this because this is going to have a lot of relevance when it comes to the margins that you're going to need to have in your accounts. Okay. So if you're in the Forex or CFD trading and you're looking to move into futures, you're going to have a lot of options as far as the instruments that you're still going to be able to trade. So even if you move over, you're still going to have access to the main markets in Forex CFDs. So like Euro US dollar, you're going to have the 6E from the CME. GBP USD, you're going to have 6B. So this is basically the futures contracts for Euro, for the British pound, Australian dollar, yen, Then for the S&P, you're going to have the ES, NASDAQ, the NQ, gold, GC, crude oil, the CL, natural gas, the NG, and then, for example, bonds, the US 5-year note is the CF, Bitcoin, Forex. I mean, obviously, you can just trade Bitcoin directly on a crypto exchange, but there is Bitcoin CFDs as well. And then there's also Bitcoin CME futures as well with the symbol BTC. Okay? So, future symbols and hours. Again, we talked about 23 hours a day, but different markets are going to have slightly different hours. So this is a handy chart for you to have. Most people are going to be trading indices, currencies, and probably like metals. You know, some people will trade bonds, interest rates, and maybe energies, maybe like crude oil or gas. Grains and meats are not really that common. But again, here you have all your times for this. So then just remember, every day between the close and the open of the next day, that's going to be what's considered an overnight trade. Now, the names for the future symbols are pretty easy. The terminology that they use, if you're doing like an indice like the SP 500, for example, right now we will be trading the September 2024 contract. Equity index expires every trimester. So every 3 months, you're going to get a new symbol. So basically, first is the ES part of the name. That's going to be the symbol for the S&P 500. Next, you get a U. This is going to be the month of the expiration. And we have this little sheet right here from the CME where it assigns a letter for each of the months of the year. So when you see the letter U, you know that we're going to be talking about September. And then 24 at the end is going to be 2024 is just the expiration year. Okay, so if you were trading NASDAQ, it would be the same thing. It would be NQU 2024, etc. For currency and crypto futures, the expirations are monthly. So again, you just have the first part of the name is the symbol. So 6E is the Euro FX futures, BTC Bitcoin futures. Then the month N. So again, this is a monthly expiration. So we're right now in July. So N would be a July expiration. And 2024, the year that it expires. Now, futures contract rollover. And again, if we're talking about, for example, NASDAQ or the S&P 500, which expire every trimester, this is what's called the pace of roll, and you can find this on the CME website. And this tracks the migration of traded volumes from the current contract into the upcoming contract. So here you have the trade volume on the Y scale and the days to expiration on the X axis. And you can see here in this case, the September contract is going to expire on September 20th. So what's going to happen is you're going to notice once we start going into like the last week, probably when there's about like 5 days left in the September contract, people are just going to start moving into the December contract, and you're going to see volumes for September starting to go down the closer we get to expiration, and the volumes for December are just going to start increasing and increasing more and more as we get into the next contract. And then the same cycle is going to happen. People are going to be trading the December contract until we start getting closer to the December expiration, then they're going to start moving into the March, and the whole cycle continues. Okay, so let's go right here. I'm in trading view just to quickly go over contracts, and so you can understand exactly what we mean by rollovers, and you can see it on the chart. So here in trading view, if you go to settings, events, you can see there's an option here that says continuous contract switch. If you enable this, this is going to show you this vertical lines is going to be when the contracts will expire. So here you can see we were on the September 23 contract. It expired here in September. Now we're trading the December, which expired here in December 8th. Then we move into the March. This is a daily chart of the NASDAQ market again. Okay, if we want to see individually by contracts, when you go here, you'll notice that we have NQ1 exclamation. This is what's called a continuous contract. And what this does, let me put in the volume indicator as well here on the bottom. Right there. So here, the continuous contract is going to attach all the future contracts together. So as soon as one expires, then it starts into the next one in one smooth chart. Because if we don't do that and we just go to individual months, if I just put NQ and I bring this down, you can see we already have a bunch of contracts into the future. Okay, so if I go, for example, just in the September 2024, you can see how we started getting a lot of volumes here right before the June contract was about to expire. And then all the volume came in. But you can see here, the chart looks all screwed up because there was hardly any volumes here, because people, when we were back here in like August of last year, we were trading the September 23 contract. So then slowly, as the date approaches into the expiration here, then people start moving into the next month, etc. And you can see here, if I go and I put the next contract for December, you can see that it's getting some volume already, but once we're very close to the September expiration, this is going to have a lot more volume in this as well, okay? But generally, when you're trading, you want to have a continuous contract on your chart, just because then it's going to be a lot easier, obviously, to track as one clean chart using the current contracts for every period with the highest volume information available. Okay. One other thing to note, and I have a whole video on this, you can see there's an option here that says back adjustment. If I take this off, you'll notice that between contract expirations and opens, there's sometimes little gaps in this, okay? Where it jumps from the close of the, in this case, from the June 24 contract into the September, and there's a gap up in this, okay? If you press back adjust, this is going to close the gaps, so you get one smooth transition in between contracts, which is what I like to use. Okay, so let's go back into the presentation. Now, futures market, again, I talked about some of them already, but here's just a quick overview of most of the contracts you're going to have available. CME group is divided into 4 groups or 4 subdivisions. You have the CME, which is where you'll find all the indices like the NASDAQ, Russell, ES, and the micros as well. Then you have the New York MEX, which this is, you're going to have like your commodities like crude oil, natural gas. Then you have CBOT, which is going to be the bonds. CME is going to have also the agricultural. Then the CME also has all the currency futures. CBOT has commodities like corn, soybeans, more agricultural products. And then the COMEX has the metals. So you're going to have copper, gold, micro gold, silver, etc. Okay? So you get a lot of options when it comes to futures. Now, fees and commissions. One of the nice things about futures is since it's a centralized market, all the volume information is coming from one place, and it's very transparent when it comes to costs. You're going to know exactly how much commissions you're going to be paying for every contract, etc. So overall, there's 4 basic types of fees incurred when active trading a single futures contract: exchange clearing fee, National Futures Association fee, broker commissions, data fees. All the fees are assessed on a per contract basis. The fees listed above are quoted to the trader by the trader's broker firm on a per side or per round basis. So if I tell you, if I'm trading NQ, the mini, and I say I'm going to open one contract, my per side costs are $2. That means that when I open one trade, let's say long, I'm paying $2 in commissions. And then when I close it, I'm going to pay $2 again, because remember, you're buying one if you go long, and then you're selling one if you want to close it. Or you're going to get what's called a round turn quote, which when you talk about round turn, this is going to be the complete cost for opening and closing a trade. So in this case, a round turn trade on the NQ, let's say, is going to cost you $4. Okay? So that means if you win $100 on the trade, you're going to actually win 96 because you got to deduct $4 in commissions and fees. If you lose $100, you're going to lose 104 because you're adding on commissions and fees to your loss. Okay? Now, fees, commissions, this is going to vary by brokers, etc. This is just a sample of commissions and fees all in round turn for different instruments in futures. Okay? I took this screenshot from My Funded Futures, one of the best trader funding companies out there. This is the commissions that they use. So I just took a screenshot of this. But even if you're trading a live account with like EdgeClear, Stage 5, Tradeovate, etc., it's going to be pretty similar, okay? But, you want to try to find a broker that is going to offer you, the lowest commissions possible. Now, data fees. This is going to vary as well, but it's important to distinguish. There's 2 status of traders. There's what's considered non-professional and professional. So most of us are considered non-professional because we're not working for the CME or a hedge fund or any professional financial institution. Then we would just qualify as a retail trader, non-professional, okay? And we're going to be paying a lot less commissions than what's considered professional. So if you've noticed, when you sign up to trade on a platform, etc., or with a broker, they will send you paperwork to sign where you're certifying yourself as a non-professional, let's say. This is what I use in Sierra Chart. This is a screenshot of Sierra Chart, and this is what I use every month to trade my live account to get live CME data. I get CME with market depth for non-professional trading accounts, and you can see I pay $12.50 per month in data fee, live data fees from the CME. If you're doing a trader funding company like My Funded Futures, Apex, Top Step, etc., which, by the way, you can find great discount codes and links down in the video description. But if you're trading those, you'll usually get the data fee included in your monthly cost of the evaluation or the sim funded. But if they move you into a live funded account, you will qualify as what they consider a professional contractor. So then you will be paying, I think it's like $110 or $120 or so in professional data fees. This is going to go straight to the CME. This data fees, this is not going to Sierra Chart. This is not going to, your broker. This fees are paid directly to the CME for the data. Now, margins. Margin basically means the amount of money that you need to have available in your account in order to be to open a certain size position. This is obviously mostly applicable for a live account that you have. So this is a screenshot. This is from Edge Clear that I had from their margins required for some of the most common futures markets. And I'm going to talk about the difference again between day trading and swing trading futures, okay? When you're holding trades overnight, then you're going to be having a full maintenance margin. So if you're trading, let's say you're trading micro SP 500 here, you can see how if you're just day trading, you're going to be paying as little as just 10% of your maintenance margin. So I've seen brokers with as little as $100 per contract of micros in order to day trade. Whereas if you're doing overnight trading, if you're holding trades as a swing trade through the hourly close every day, you're going to be paying, like you can see in this case, $1,240 for a micro SP 500. Whereas if you're day trading, you're going to be paying about 10%. You're going to need to have like 10% of this amount, okay? So that's why day trading is such an attractive option as well, because you're going to need a lot less capital when it comes to futures trading for that, okay? Now, to finish off, let's talk about a run through of what is mainly driving traders to switch from Forex CFDs into futures. And again, like I said at the beginning of the video, I feel like futures are like the most mature and professional trading market there is. Traders will tend to start off in like crypto or Forex. That's my personal case, was just like that. I started in the crypto space, then moved to Forex, CFDs, and then eventually, since like 6 years ago, I've just completely full-time moved into futures because of all the advantages it offers. So the two main reasons I think that it exploded in popularity, first of all, in 2009, they introduced the micro indice futures, okay? That means that they introduced the SP 500 and the NASDAQ and the Dow Jones micros, etc. So that meant that traders, instead of having to have, over $1,000 per contract to be able to just day trade in futures, which was, a pretty high entry barrier. You can now trade with as little as $100 margin per contract. Okay, so when that came out, that just opened the door for a lot of smaller retail traders that were looking, to trade futures, but they didn't need a ton of capital to get started in it. Second, popularity of trader funding companies like Apex, My Funded Futures, Top Step, etc. This has really brought a lot of attention to the futures market from retail traders because, there's been funding companies in the Forex space for a long time, but Forex is not really very highly regulated. There's a lot of scams and things going on. And so there's been a lot of bad experiences with funding companies in the Forex space, and traders are looking for something more safer, more regulated, that they know, that they're not going to get just scammed, etc. And so this funding companies focusing on futures have really helped also to drive traders to move from FX to futures, and they're still going to get access, to euro futures, pound, etc. Okay, next one is, like we talked about before, a more regulated market. So futures brokers are very regulated in the US. So it is very rare that you're going to hear of, a futures broker or customers having, problems as far as with their accounts, with money, their balances, or money missing, etc. And so in that sense, that gives traders a lot more security, and they also know that they are getting, a more fair product. Next, more professional and knowledgeable market participants. So like I said before, I feel like futures is the most mature market out there, where you have the most serious and professional traders in it. And I think as traders get more experience and evolve more as the years go by, then they will gravitate more toward a market that is, has more of the qualities of the futures market. Next reason, accurate volume data. So again, it's a centralized market. In this case, we're talking about the CME, all data going into and out of the CME, and this is a very key point for order flow trading. If you want to be using delta, footprint charts, etc., CBD, you want to really have an accurate measure on all the buying and selling activity, and there's no better market in the world than futures when it comes to having all that information for that style of trading. Next, excellent customer support with futures brokers. I've used 3 different futures broker companies in all these years that I've been trading them. Again, I've used EdgeClear, Stage 5, and Tradeovate in the past. I'm currently using Stage 5. And I gotta tell you, their customer support is always excellent. They always have phone numbers available that you can call, and right away you can get support if anything happens on with your account, or even by email, because there's competition. So they really fight to keep their customers and make them happy. Okay. Next, we have futures market are very liquid, and many trade beyond traditional market hours. So again, even though stock markets are open during what we call regular trading hours from 9:30 a.m. to 4 p.m., we still get trading in the Globex session. Again, markets open at 6 p.m. Eastern, so you can trade overnight into what will be called the Asia and the Europe sessions as well. And so that's going to give you access almost 23 hours a day, 5 days a week. And then markets, if you're trading NASDAQ, SP 500, gold, euro, futures, they're going to be really, really liquid, meaning there's going to be a ton of orders at every tick level on the DOM, on the price scale. So even if you're going to be market buying or selling one or several contracts, you'll most likely just get filled one tick level up or down, pretty much just paying the least amount of spread. So you're going to be getting very good fills. If you put a limit order, you're almost guaranteed to be filled in at the exact price that you put that limit order in. These are things that in Forex market and CFDs are very manipulated. You get a lot of slippage, very wide spreads, etc. That's not the case when it comes to futures. Then another thing I talked about before, very clear costs, commission and execution costs are low, and they're charged immediately once you close the position. You know ahead of time exactly how much each contract or position is going to cost you in a specific market, etc. Okay? Then markets are more efficient and fair, less insider trading. Again, this has to do with the regulations and markets being very liquid as well. They're just gonna get very good executions, very little slippage, and they're very regulated in terms of they're always trying to crack down on spoofing, on people that are trying to put in manipulative orders, etc. Next, just like Forex, is very easy to short sell. So if you're trading stocks, you know that there's a rule when it comes to actively buying and selling stocks, going short, that you need a very large amount of capital. If you're trading, index funds or mutual funds, you know that obviously you cannot go short on those markets. Just like Forex and CFDs and futures, you can easily just go long or short, and that's going to be open up a lot more possibilities when it comes to trading. And then just like Forex and CFDs, there's a high leverage when it comes to futures market. So that means that even if you're just using a little bit of capital as margin, you're going to be exposed to a very large notional position that is going to really help you to multiply all those profits. Okay, so that's pretty much it for the video. Again, I hope this has been insightful into how futures market work, and how if you're trading Forex and CFDs and looking to go into futures, it's a very excellent choice. I would say I would never go back really to trading other markets. I mean, I do trade crypto, but I think crypto is like its own separate thing. But when it comes to futures trading, I would not go back to trading any Forex or CFDs if I have access to futures trading. Okay, that's pretty much it. Any questions, comments, leave them down below. Make sure to subscribe, hit the like, and I'll see you all in the next one.